Let us continue with our sampling from this call.
Then put the money in real estate, but don't put it in this crap.
I have to respectfully disagree.
Well, on what basis? He's getting more money if you put it somewhere else.
But he's able to borrow against this.
Hey, if you've got $25 million in mutual funds, you can borrow against it.
But he's going to have to wait until he's retired to get that amount of money.
Okay, so you're going to teach him that the way he becomes wealthy is borrowing against money that his father invested for him. That's how he builds wealth. Said no one rich ever.
Okay, so here, again, the caller obviously has been trained in the Jedi arts, and he's explaining to Dave, well, no, like you want him to put the money in a mutual fund, but he can't use it. And then Dave is talking about, well, no, you can borrow against it. So here, that's the problem sometimes with Dave. Like, he could be a moving target. So it's not sure, what do you have in mind? So I think probably in some settings, Dave would be saying, I'm talking about putting it into a tax qualified plan and and then you can get all these great advantages, where there are strict limits on when you can access the money. Specifically, if you start taking it out before you're 59 and a half, you get hit with 10% penalty, things like that. Okay, so that's what the caller is referring to as saying, no, well, with what I'm doing with my son, this policy, he's going to be able to use it without any penalties. He doesn't have to just leave it sitting in a prison until he's 59 and a half. Okay, so that's one element of what's going on. Let me also mention, I forgot to make the point, technically this would have gone with the previous clip, where Dave is matter of fact saying, 11% rate of return in a mutual fund, what are you doing? Well, another thing that overlooks is the fact that the whole life policy is life insurance, right? And so if this guy's child, hopefully he does live to be in his 80s, and that's the issue, is him sitting around saying, I only have $2 million in my cash surrender value of this whole life policy that my dad gave me. And some people are saying maybe it would have been a lot more if it had been a mutual fund. Like, that's a good problem to have. If you have a thing that's only worth $2 million that your dad gave you, and it could have been worth something more, maybe if you picked a different asset, right? Like, hopefully everybody ends up having that problem. And that's why they're mad at their parents when they're in their 80s, is that, you gave me this thing that's not only worth $2 million, it could have been something else. That would be great if that's the issues kids have with their parents. But besides that, though, this child might die early, right? We hope he doesn't, obviously, but he could. And so if he dies, so for the policy that I asked my colleague at Infineo to draw up, when the kid is 20, so again, the numbers are going to be a little bit different from what the caller's policy is going to say, because the timing of when he did this funding was off, or it's different from what I have here. But for example, the policy that I showed you folks, at the end of year 20, the death benefit is $846,000 and change. Okay. So if Dave's strategy is, if they follow Dave's strategy and the guy's putting that funding into a mutual fund and the kid happens to die at age 20, the mutual fund is not going to be worth more than $800,000, right? It's not. So again, there's different assets. So what I'm getting at is, part of the reason the internal rate of return on a whole life policy is relatively modest is that it's life insurance. It's not merely a vehicle that's taking your payments and going and investing them in assets and then passing it along to you, except for some fees taken off the top. That's not what a life insurance policy is. It's life insurance. And so from the moment you take it out, that death benefit coverage is in place. So that the caller said his policy for his son, the moment he opened it, there was a $500,000 death benefit, and then that thing is going to march up over time. Okay, whereas if you're putting in a mutual fund because, the long run rate of return on this thing is higher, well, then that's not true. Now, incidentally, you could try to split the difference and say, no, Bob, but what if we buy term and invest the difference so that we got the death benefit coverage in place early on? Okay, you can go ahead and do that, but still, there's that intermediate period where the term policy falls away. Or if you want to keep it in force, you got to renew it now with much higher premium payments. Whereas the whole life policy, it's a fixed premium payment throughout the standard design. Okay, so all of these comparisons, they're each assuming different things. So yeah, you could, if you want, have a term policy in place, but then you're not putting as much into the mutual fund. Okay. So I'm just saying right here, when Dave was trying to get this guy to see how goofy his idea was for his kid, he said, take the same amount you funded in that policy, go have it earn 11% on an online calculator, and then see how much you'd have. Okay. So in that scenario there, Dave wasn't doing buy term and invest the difference. He wasn't doing buy term at all. He was just saying, take those same cash flows, put them in a mutual fund, and assume it earns 11% for the next 80 years, and then go see how much that's going to be worth. Okay, so I'm saying if that's what you're comparing it to, it is entirely fair for me to say, okay, but if the kid dies early in that scenario, Dave, he gets way more with the whole life policy than with what you just suggested. Now, again, you could come back and say, oh, okay, well, if that's what you're worried about, then do a buy term. Fine, but then you can't take all those cash flows and assume they earn 11%. You're not earning 11% in cash surrender value growth in the term policy. You don't have any cash surrender value growth. If the kid doesn't die during the time that the term policy is in force, your rate of return on that was negative 100%. All the premiums you paid are gone. In fact, do you know that if you have a term policy and you outlive it, the life insurance company keeps your death benefit? Do you know that? Yeah, life insurance keeps your death benefit. Make sure you go look that up. See if I'm right. It's kind of nefarious, don't you think? You're sitting here paying your premium payments on this term policy and then they keep your death benefit? Oh, imagine that.
Hey everybody, this is Bob Murphy. Thanks for listening to this clip from the Infi podcast. If you like what you heard and want to hear more, please consider subscribing and share this video with others. We've got new episodes dropping every Friday with more insightful discussions. Stay tuned.